Good evening, friends. Hope you are well and doing fine. I, Ashok Kanawala, on behalf of HDFC Mutual Fund, extend a warm welcome to all of you on this call to discuss economy and market outlook. As you all are aware, that India has been a shining star as far as global markets are concerned for last over a year or so. Uh, but when the things are going good from the economy and market perspective, into 24, there were two key events which were sort of very critical for our medium to long term direction. One was the election, which got over in the month of June, and the other was budget. This budget, which was announced yesterday, was post the interim budget that was announced February because of the election. So with this, the final budget is also out. Now, what we understand from this budget directionally, that we need to understand from two sides. One is how the budget finances are sort of constructed, because that will have some bearing on the government borrowing program and fiscal deficit and over period of how it is going to pan out. So that's what to do with fiscal math and have therefore have some implication for the bond market. And on the other side, when equities are near all-time high, and of course there have been some kind of concerns as to valuation, etc. And of course, the budget also announces various measures which can support certain sectors, themes, etc. So from that perspective, where are the opportunities on the equity side? So to discuss both this aspect, we have two people from our side, Shobhit Mehrotra and Chirag. Shobhit is our head of fixed income and Chirag is our head of equity. Both together have more than 50 years of experience, have seen a lot of business cycles and budgets and in terms of interest rate movements. So we thought that let them have on this call and to give their perspective in brief what they think about this budget from a debt side, from the equity side, and of course, post that we'll open the session for question and answers. And of course, with me is my colleague Sandeep Singhi, who will help me moderate this call. So, without much ado, now I invite Shobhit Mehrotra, head of fixed income, to say his opening remark on what he thinks from the fiscal math in terms of how these government finances are structured and what he thinks in terms of its impact on inflation, interest rates, and bond markets. Post which, we will invite Chirag to share his thoughts on the equity side. Over to you, Shobhit.
Hello. Thank you, Ashok, and thank you everyone for joining in on this webinar today on markets and outlook. Let me straight away start with the key takeaways from the budget which was presented yesterday by the FM. If I were to look at it objectively, there are three major positives as far as I'm concerned on the budget which I saw yesterday. The first one was, despite the election outcome, despite the pressures of coalition politics and fear of fiscal populism, the government has continued on the fiscal consolidation path. The deficit number most analysts were expecting would remain same as the interim budget at 5.1, but the government improved on that and has now come up with a number of 4.9%, with a commitment to bring it down to 4.5 for FY26, and thereafter from FY27 onwards, there is no specific target in terms of fiscal deficit, but overall debt to GDP would be on a declining path, which means that perhaps fiscal deficit would continue to remain on the lower side and may perhaps be in the region of 4% or thereabouts. So clear medium-term fiscal consolidation path, despite pressures to increase spending. The benefit obviously has come from the large RBI dividend. The RBI dividend number, which was almost 1.3 lakh crores extra, a large chunk of it has been utilized for bringing down the deficit. and some of it has been utilized for increased revenue expenditure. So that being the first positive, the second major positive is that if you look at the quality of data, the estimates are quite conservative in terms of tax to GDP, the growth in direct taxes, which has been assumed, growth in corporate tax, tax to GDP as a ratio, tax buoyancy number on a nominal growth of 10.5 on the GDP. Tax growth is being assumed as 10.8. Given that the first couple of months data is already showing buoyancy, which is better than this, our sense is that achieving these numbers is going to be quite easy for the government, and perhaps they should be able to better it, which means that fiscal deficit for this year could be achieved quite comfortably or may even be improved upon. Now, on funding of the deficit, clearly the preference has been to fund it more without decreasing the long-term dated borrowings, which means that the borrowings which were to happen through T-bills, those have been reduced, but longer dated borrowings have not been reduced by as much. Now, this is clearly being done because the government knows that because of India's inclusion in JP Morgan Global Bond Index, long-term bond flows in this year are going to be quite good, which means there is a lot of demand for dated securities, and perhaps there is no need to bring down the supply of dated securities, and therefore the preference has been to utilize the extra cash or higher cash surplus to bring down short-term borrowings. Now, all these measures have a positive impact for bringing down cost of capital for the economy, and not just for this year, but next couple of years. The trend for India is therefore going to be of a declining cost of capital, which is hugely positive for the markets. So that being two major positives which I've already mentioned. The first being the fiscal consolidation, the second being the quality of data, the credible set of numbers and conservative estimates, and the third major positive is that capex to GDP has been retained at 3.4% of GDP, which is a fairly big jump in the last 5 years. For a long period, India's capex to GDP number was struggling around 1.7 or less than 2%. In the last 5 years, we have seen steadily this has been increased to 3.4% of GDP, which is a big positive and gives you a good growth impulse. Besides this, what one sees is there is a lot of focus on job creation. There are employment-linked incentive schemes. Now, a number of these schemes and programs which have been announced, it would entirely depend on how the implementation or the execution happens in this year and going forward. In case the implementation and execution is fine, then perhaps there is a boost to consumption and growth impulse for the economy would continue. Besides this, there has been an announcement on vision and strategy document for the financial sector. There has been some factor market reforms for land, labor, capital. Now, all these are more medium term, long term in nature, but we need to see how they pan out. So broadly speaking, I think the from bond market perspective, the budget could not have been better in terms of the fiscal announcement or fiscal discipline, the path on which the government is clearly committed to. The borrowing program gets reduced by a slight amount for the current year. My sense is as we progress into the fiscal year and we continue to see robust tax collection, there is a possibility at some point in time that perhaps dated borrowings could be reduced, which is again going to be positive. But broadly speaking, from the bond market perspective, the demand-supply scenario is highly favorable because of inclusion in JP Morgan Global Bond Index. We've already seen a very large chunk of money which has already come in. Every month end, the weight of India is increasing by 1%, and these flows will keep on increasing. In this month itself, we've seen almost 16,000 crores of FPI inflow coming into the bond market. For the remaining fiscal year, we would continue to see large chunk of FPI flows coming in. So demand supply for bonds is extremely favorable, and because of that, bond yields would trend to go lower from about 696 where the 10-year is. So our view has positive on the bond market. We feel the direction for yields is to come lower. Liquidity is improving. Inflation is headed lower. Hopefully, the monsoon turnout will be good. And thereafter, we would see perhaps RBI moving after the Fed. Globally, we expect Fed to start the rate easing cycle in September. Therefore, our view has been to increase duration in this market, and we feel going long and going on longer duration on debt would do well. So with that, I'll stop here and pass it on to Chirag for his views on the budget and equity market.
Thank you, Shobhit. Thank you, Ashok, and to everybody who's joined us today. So I think Shobhit has covered it in fair detail, but let me just highlight or reiterate some of the things that he pointed out. They are equally relevant, not only for the debt market, but also for the equity market. I think his point on fiscal discipline is well taken. It is obviously relevant for fixed income, but equally relevant from an equity standpoint. At the same time, the numbers, as he pointed out, have been very reliable. The arithmetic from a revenue perspective and expenditure perspective, both are numbers which are very credible. And that gives a lot of legitimacy to this budget. And hence, I think it has been overall well received by most participants. Let me just highlight some of the things which are a little bit more pertinent to equity markets specifically. Now, of course, the one which gets the most decibel levels is the change in the capital gain structure, with both long-term and short-term having been tinkered a little bit. So considering the returns that we've seen in the last couple of years, I think having a 10 to 12.5% increase and a 15 to 20% increase, I don't think these are large numbers. I think investors, from an India standpoint, we invest for the long term and our return expectations are fairly high. So I don't think this sort of changes the story very much. I think what is particularly important is post this tinkering now, the short-term capital gains rate is including the cesses comes to close to 25%. Education cess and additional cesses come to almost 25%. So I don't think there'll be much tinkering to the short-term rate going forward. The long-term rate is already at around 12.5%, and with cesses comes to close to 15%. So I don't see that also changing going forward. So I think we want to talk about not only what happened this budget, but also what potentially can happen going forward. I don't see those rates getting changed much. I think most of that work has been done. I think the one part, and you can see that the government clearly has tried to align rates across asset classes. In equities, long term is still considered to be 1 year, versus in most asset classes it is considered to be 2 years. So I think that is one change which is left to be made, and that could potentially happen sometime maybe in the next budget or thereafter. But I think that's one change yet to be made. Let me also point out a few other things which are relevant from an equity standpoint. The buyback rules have obviously changed, and buybacks now will be taxed in the hands of the individual at the marginal tax rate. And this makes buyback a far less efficient way of deploying surplus as opposed to dividends. So I think the buyback route, at least for now, has been shut, and we will see a shift to dividends, and dividend payouts will possibly increase. I will get to a sectoral impact, but let me also talk briefly about other asset classes. The change in duty as far as gold goes, which was reduced from 15 to 9, I think that's or 15 to 6. Sorry, that is certainly a welcome change because it reduces the incidence of smuggling into India. It's also positive for certain specific FMCG companies, and we've seen that price movement. Gold has already fallen by that level, by that extent, and these stocks have already reflected that in a positive fashion. Companies like Titan, etc. The abolition of the angel tax, while it doesn't affect listed equities, is good for the overall equity ecosystem. So this angel tax, which was applied at 30%, was hampering the fundraise of smaller companies well before, of course, they come to markets. But the fact that this has changed is certainly something which is a positive. The change in STT, I think government is clearly aware that options and futures and speculation, for that matter, has risen considerably, and this is some effort to temper that. Though I don't think it'll have the desired result. I don't think the measure is strong enough. So I think speculation and options and futures usage will continue as it has in the past. So that's a sort of a broad comment. The real estate tax, of course, as you know, has changed a little bit, and we have gone from 20% and with indexation to 12.5%, and that really affects. If you're, it depends on the duration and the kind of returns that you've generated in real estate. So it's not necessarily a positive or a negative. It depends on the individual circumstances. But if you are invested for an extended time frame and if your returns are reasonably high, then actually the new tax regime is actually a positive and not a negative. So when you look at it from a sector standpoint, really, there are 2-3 effects I'd like to call out. One is the capex has been maintained at roughly 17% increase over the last year. And I think that's a healthy capex number, and that bodes well. Within that, defense has been increased by about 11%, which bodes well for defense capex. Road and rail capex has been a little bit more muted at sort of 3-4%, but defense capex has certainly been quite positive. But overall, the overall capex number continues to be healthy, and I think that's good for capital good companies. From a consumer company standpoint, the lack of tax on tobacco is good for tobacco companies. The fact that gold has been brought under a different or a new custom duty structure brings down gold prices, and it is good for gold retailing companies. Employment measures, and a number of those were announced to support employment, to support upskilling. All of those are good from a consumer standpoint. So I think sector in general, I mean, it's been generally good for not only for capex companies, but also good for some of the consumer companies. The real estate impact, as I pointed out, is neutral. There wasn't much in it for IT, pharma, auto. Telecom, some marginal tinkering on custom duty rates, a little bit negative for the electronic manufacturing services sector. But in general, not a big effect on telecom, and defense has been a little bit positive. So I don't see, I think the budget, let me summarize it by saying, I think many participants and observers have commented, I think it was a well-balanced budget. The fact that the government could easily have given up on fiscal discipline, and it didn't. Government received 130,000 crores additional from RBI, and that money could have been spent entirely, but it wasn't. Half that money has been spent, and half of that money has gone to reducing the fiscal deficit, and I think that's a very prudent way of doing things. The expectations from a sort of revenue standpoint are reasonable. Shobhit pointed out GDP growth growing at 10.5% is a reasonable expectation, and tax collection growing at roughly the same pace is also a reasonable assumption. So I think all of these things have been well taken. The emphasis on employment is something which is the need of the hour, and I think that will continue in the next budgets going forward as well. The emphasis on housing is certainly welcome as well. It creates a lot of downstream demand for cement and steel and household products and so on. So I think that is certainly welcome as well. So I think overall budget has met most expectations, and you can see that in the response in the equity market as well. A little bit of nervousness or a little bit of apprehension because of the change in taxation structures, but otherwise nothing negative in this budget.
Budget जो गया है खत्म हुआ है, budget which has just got over yesterday. The story coming out is very simple. Fiscal consolidation, as Shobhit explained. That's a good news that India does not want to become populist. Populism factors nahi hai budget mein. They are very in line with what they have been doing in past. And one more additional factor this time was that job creation, which has been a key point of discussion. It was a big discussion even for the election. That job creation has been to an extent, I would say, addressed here. The focus of the government, जो government का infrastructure और capex में जो manufacturing में जो focus है, आत्मनिर्भर भारत and विकसित भारत, that direction that government has sought for itself, that continues in terms of its spending. तो वो पैसा उस पे लगता रहेगा, तो उस पे काफी spending है, maintain किया है, उस पे कोई घटाव नहीं है. So I think overall the direction of the budget in terms of its overall direction seems to be very positive from the market. Maybe some taxation changes यहाँ हुए हैं थोड़े, but I think from a mutual fund perspective, the categories which were out of a taxation perspective in terms of any tax benefit have been brought back. That's a positive. And some marginal increase in tax is there from 10 to 12.5%. But rather, other than that, mostly ये जो budget है, वो I would say positive note पे है, क्योंकि direction wise इसमें कोई ज़्यादा change नहीं है. So election over, budget over, focus on the India growth story, and of course some global event which is like US election, which is pending, which is there in November. So there will be some news coming out of US that we expect that can have some kind of implication of volatility or nervousness in the market. Other than that, India's story remains on a stronger wicket, shining star, oasis in desert, fastest growing. Every IMF, everybody is improving or increasing our growth rate. So I think from that perspective, the overall story remains positive and bullish, and we continue to maintain the same stance as we did. Markets are overvalued or maybe in some pockets valued. So some kind of caution is advised, and baki theek hai. So thank you, Chirag. Thank you, Shobhit.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.